Investors simply can't wait to be pricing out the war and pricing in a peace rally, but it's simply too early. Iran has rejected yesterday the US proposal and continues to signal resistance, while rhetoric on both sides suggests negotiations remain fragile at best. And this growing disconnect between market pricing and geopolitical reality is striking. So with tensions unresolved and risks still building across energy, interest rates and geopolitics, the downside remains unappreciated. So pricing out the war now may prove premature and potentially costly as well if the situation in the Middle East deteriorates further. So welcome to Swissquote's daily market talk. It's 26th of March. I'm İpek Özkardeşkaya. We will talk a lot of things today again, but remember that everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So the US sent a 15-point plan to Iran to end the war in the Middle East that Iran publicly refused. That's the big summary of what's happening right now. Iran proposed other conditions instead and continued to attack the region. So there is no material de-escalation of the war. The situation today is not better than a week ago. On the contrary, it's just that investors are just too excited to price out this war. And we saw that yesterday very clearly as equity investors bought the US 15-point peace plan and hardly reacted to Iran's rejection. So the S&P 500 rose 0.54% yesterday, and despite trade and geopolitical uncertainties, analyst estimates for the S&P 500 earnings growth improved since the start of this war, according to Bloomberg Intelligence. Expectation of profit growth rose from 10.9 to 11.9% since the beginning of hostilities in the Middle East, which narrows the disappointment margin obviously when these earnings come out and increases the risk of a further market meltdown. So it's no surprising that the index still saw resistance into the 200-day moving average yesterday as US crude jumped 4% during the session. Oil is still higher this morning. Brent crude is preparing to regain the $100 per barrel handle this morning at the time I'm talking here, while Asian equities are down and US and European futures are pointing at a lower start as well. Investors are obviously willing and trying to price out the war as quickly as possible and price in a peace rally, but before time. So risks loom and downside risks prevail. Now on the talk side, Trump insists that peace negotiations continue with Iran, and what they're doing in the Middle East is big. I even heard the word beautiful in that sentence. I'm not sure, it's hard to listen to these, but he's no longer controlling the narrative. That's the thing, because one of Iran's major war figures mocked the US, saying, "Has the level of your inner struggle reached the stage of you negotiating with yourself?" This is where we are in terms of negotiations. But yes, Donald Trump is desperate to end this war and as quickly as possible, as political and geopolitical pressure is mounting to unbearable levels into the midterm elections in the US that are due this November. Deutsche Bank even came up with a pressure index, it's amazing, that takes into account several factors like the 1-month change in Trump's approval ratings, the stock market performance, and whether people and bond markets are expecting higher inflation, and they just spit a number. So that pressure number on Trump is at the highest level since his inauguration early last year. That's the fun part. The less fun part is that the pressure is creeping beyond oil prices in the US economy as well. Mortgage rates there, for example, returned to the highest level since last October, and that's waiting on new purchase applications as well. Now, this benchmark mortgage rate is calculated using the US 10-year yield and a risk premium, and both rose since the beginning of hostilities in Iran, has sent oil prices and inflation expectations higher, along with the debt worries on higher military spending. So the US 10-year yield rose up to 50 basis points after the dip that we saw at the beginning of the month of March, as investors went from pricing a rate cut from the Fed this summer to pricing potential rate hike later this year. And activity on Fed funds futures today assesses around 30% chance of at least a 25 basis point rate hike before this year ends. In the FX, the US dollar appreciated yesterday and a slightly better bit in Asia again this morning. The euro dollar and cable were both under pressure despite the rising hawkish ECB and Bank of England expectations here. In mainland Europe, the ECB chief Christine Lagarde said yesterday that the bank will not be paralyzed by hesitation in responding to the energy shock from the Middle East war, meaning that they will hike rates. While in Britain, the hotter than expected inflation numbers, partly on falling energy prices in February, confirmed that the energy shock that hit the fan in March will sharply change the inflation's trajectory in the UK and may oblige the Bank of England to adopt the monetary policy accordingly, meaning we could see rate hikes there as well. In Westminster, Rachel Reeves went a bit ahead of herself yesterday, saying that they will speed up the construction of power plants and that these power plants could come in force by the end of 2027. That's the end of next year, so that's a bit optimistic, but it shows how Europeans are willing to move back toward nuclear and they cannot go there fast enough. Now, Global X Uranium ETF was up by 1.58% yesterday, but has been falling since the start of the war in Iran, despite Europeans' pledge and willingness to go back to nuclear, because they have simply no choice. So the medium and long-term outlook for uranium still remains positive, and current levels could be interesting for the bulls to return to the market. Elsewhere in commodities, well, gold reversed the past two sessions gains in Asia this morning. The precious metal is down by more than 1.5% at the time I'm talking here, as optimism regarding a Middle East peace is waning right now. Other metals, including silver and copper, are also under the pressure of higher US dollar, higher yields globally, and deteriorating global growth expectations, as the war could well extend beyond a month. Obviously, commodities and tips remain the best hedges in an inflationary environment, but uncertainties are so high right now that cash is king. And when people say cash, they usually mean the US dollar. But when the dust in the Middle East settles, well, the hawkish divergence of the European and other major central banks compared to the Federal Reserve could eventually set a ceiling to the US dollar's appreciation. Because remember, the US dollar and US treasuries were both losing their international appeal due to hectic US trade policies, growing US debt, and US deteriorating international relations that pushed the central banks around the world to diversify their reserves away from the US treasuries. So we will very likely return to that long-term trend, but today the US dollar still benefits from the fact that there is simply no alternative. So it will be quite interesting today to watch the US 30-year bond auction. The US 30-year yield has also moved higher toward the 5% level since the beginning of the war in Iran, on expectations that the inflation could be higher, but also on the expectation that the US may have to spend more on military than they were expected to do so before. And if you had enough of war, well, we had mixed news in the technology space yesterday. Meta and Google were found liable for harming young people who may use their platforms because they can become addicted. So these companies will be paying fines to these people and some penalties. But their stock prices remain mostly unchanged yesterday because these fines are just a very small portion of their huge revenue, and investors can't care less about social and antitrust issues. Indeed, they have never prevented these companies from increasing their market cap, just becoming bigger, and they will not do so. The major risk to their valuation is still the delayed revenue on massive AI spending, and it stops there. So for all those who have been pointing at antitrust and social risk, I still think that these remain very marginal risks. There are talks in many countries, like Switzerland, for example, that finding them is not the solution. The solution would be to attack and maybe try to change their business model, so their platforms and how addictive they are, but that is going to be very hard to do so. And in the meantime, AI demand remains strong and growing. ARM yesterday jumped more than 16% after announcing that they will now start building their own chips for AI and data centers, and the latter will generate as much as 15 billion US dollars annually by 2031. So far, the company was designing chips for third parties. Now, note that ARM Holdings is not cheap. It's trading at around 190 times its earnings. So the new sales will certainly bring that number lower, but it won't make ARM a cheap buy. So this is all for today. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.